Okay, so today we're going to be talking about debt and credit. This is going to be a brief overview of sort of the way that credit cards work and the way that some loans work to give you a better idea of sort of what you're going to be dealing with as adults. So first, let's talk about credit cards. The reason we need to talk about credit cards is because most Americans at one point in their life will have a credit card of some sort some sort, and a lot of them don't really understand how they work. So we'll start with co-brand. Well, actually, let me differentiate between the two types. You have co-brand credit cards. These are your Discover, Visa, and MasterCard type things. American Express, where they're attached to a sort of a particular type of brand of credit card. So it's sort of like you can think of those as the ones that you can use kind of anywhere. They've got the logos on them for the companies that they're associated with, and then the private label are what were normally known as store cards. So this is like, say you go into Target or into Old Navy or something like that, and they offer you to save 20% off that day if you apply for a credit card. Those are the credit cards that you open up there. The only major difference between them is, I shouldn't say the only, but the major difference between them is that private label credit cards typically are approved for people with lower credit ratings. So if you have bad credit, it's easier for you to get approved for a private label credit card. However, they have a much higher interest rate, and they can only be used at the store they're good for. Companies do this because having their own personal credit card not only encourages you to shop there, but also it makes it so they can save on fees that they would have to pay to MasterCard or Visa if you were using a different credit card there. When you get a credit card, there are associated fees and costs. The big one that you need to watch out for is your APR, which is your annual percentage rate. This is basically your interest. So this is usually going to be anywhere between 10, maybe 8, I guess, low on the really low end, between 8 and 30%. That's a lot of differentiation. Like I said, private label credit cards are the ones that have higher interest. They'll usually have APR of usually 23 to 29%, and that's regardless of credit rating, because of the type of product they are. So that's something that you have to keep in mind, is that if you buy something and some of the charges from that purchase are still on there a year later, you've paid 30% interest on whatever it is that you haven't paid off. So you do need to keep in mind that just like how savings accounts accrue you interest, credit cards are kind of like a savings account for a bank, in the sense that you're spending money. They're giving you money to spend, but they're getting interest off it. So that is always. I mean, the biggest setback of credit cards is that when you're using them, you can buy things before you have the money to afford it, or you can pay them off periodically. But it costs you more money in the long run. Okay. Late fees are another big thing that a lot of people have to worry about. Usually when you miss your payment even by one day, you get charged a late fee. Especially if you have really good payment history, you can sometimes get out of late fees just by calling and requesting they be removed. That's coming from someone who has worked as a credit card bill collector for a number of years. Almost any credit card company, if you have a late fee and it's your first one, you definitely call and get that taken off. But late fees are usually between $20 and $40 on credit cards. That's 20 and 40. Okay, so that's a considerable amount of money to pay, especially if you're late. What ends up happening, and the reason they do this, is they charge you a late fee every month that you're late, and for a lot of people that seems counterintuitive, because if you're behind, and you can't get charged, and you keep getting charged late fees, it's going to make it harder for you to catch up. And to a certain extent, that's true. But also, what the credit card is doing is it's increasing the balance of your account so that if you can't make payments on that account, when they go to sell it, because your account has fallen, has gone delinquent for 6 or 9 months. So if you miss your payment for 6 or 9 months, they'll usually sell it to a different collection agency. They sell it at a lower rate. So, like, say you owe them $1,000, they might sell that debt for $500. They get $500 from the collection agency. The collection agency can collect $1,000 from you. They add those late fees on there so as to help cushion the cost of having to sell that at a discounted rate. And a lot of times they'll end up making a profit off of it. The late fees will be so much that they'll end up making more money even selling it at a reduced rate than they did for the amount that they initially gave you to buy whatever, to make whatever purchases you did. Annual fees are, some credit cards have them, some don't. Usually credit cards that have lower credit rating approvals have them. What this is a fee that they charge you yearly for using the card, regardless of whether or not you purchase something. And then the last thing, and then this is what you, especially as young people, you really need to look out for. A lot of times credit cards will offer you promotional interest, and so they'll offer you free, like no interest for 6 months, no interest for a year on certain purchases and stuff like that. And if you handle this responsibly and you pay it off within that time frame, it's really a good deal. But a lot of times people don't, and a lot of times they'll end up. A lot of times what they'll do is all the interest that's accruing over that time period. So say you charge $500, and it's 6 months for 6 months no interest, and you pay $200 of it over that time period. At the end of the 6 months, you get charged interest for the full $500 that have been accruing over the whole 6 months. So they'll really get you if you don't pay it off in that time period. So that is something else you need to keep an eye out for. Credit cards can be really useful for some people, but what you've got to think about is it's kind of like buying in reverse. You're buying something a lot of times before you have the money for it and then paying it off. But the threat of uncertainty is always there. You never know if something's going to happen and you're not going to have that money 6 months down the line when you plan to pay it off. So, definitely use credit at your own risk. Okay. Loans are another form of credit. They're very common. Most loans you're going to deal with are going to be auto loans. These are usually approved to be paid off over a period of between 3 to 5 years, sometimes longer. Sometimes you'll pay them off shorter. They usually have lower interest rates than credit cards. They'd better have lower interest rates than credit cards. But again, that's based on credit approval. And so you can get something as low as 1% to as high as 15%. And remember, the longer you take to pay it off, the more interest is going to accumulate, the longer you're going to be paying in the long run. So auto loans are the most common. They end up, a lot of people will end up shortly after high school going to open up an auto loan, and that'll be their first form of credit. The thing about that you have to keep in mind is that cars are not an investment. In the sense that you need a car to get to and from work, and that generates income for you. That is an investment, but in all reality, as far as like an actual piece of property, cars depreciate in value. They don't appreciate in value, which means that their value goes down the more that you use them and longer you have them. So the amount of money that you spend on a car is going to be significantly the amount of money you put into a car is going to be significantly reduced over time as that car loses its value. But it has a hidden value in the sense that it helps you get to and from a place of employment, which generates income for you. But that's just something that you need to keep in mind when deciding what car to buy, is that if you pay $20,000 for a car today and you pay $15,000 for a car today, the $20,000 car is going to drop down in value at probably the same rate, if not faster, than the $15,000 car, and so you might end up losing a lot of money you put into that. There are other loans that you can get approved for. They're usually tied to a particular task. So if you're like trying to start a business, then you have to demonstrate and like prove that you have certain ideas about how the business is going to be run, and you set up a repayment schedule with the bank. There's other things like home improvement loans, and usually a loan can only be used for what you are approved for. So if you open a loan to remodel your house, you can't go and use it to buy a new computer. It needs to be used for remodeling your house. The last kind of loan, and we're not going to talk about this much, are student loans, which can be used to pay for education. These are very, very low interest loans, and they're oftentimes deferred, so you don't need to make payments on them during college. And then after you get out, based on your income, your payments can vary because of different programs the government has set up. So that's a pretty good deal too. Okay, the last thing I want to talk about briefly are mortgages. And essentially what a mortgage is a loan that's used to buy a house. Oftentimes requires a down payment and certain credit qualifications. You also need to make a certain amount of money per year. One of the major reasons for this is because in 2008, we had a major financial collapse, and lots of banks went out of business or required the government to give them money to prop them up. And a lot of the reason for that happening is because we were giving, as a country, we were giving out mortgages to people that really couldn't afford them. So we were approving people with low credit ratings or with with low income. We were approving them for mortgages. They couldn't pay for the houses. They ended up losing the houses, and the bank ended up losing the money because they had a bunch of houses that they couldn't do anything with. And so our economy sort of came to a screeching halt. The government had to spend a lot of money, billions of dollars, to fix the situation, and as a result, we've really tightened up on who can and can't be approved for a home loan. You'll hear people, just like I said, that cars are not an investment. You'll hear a lot of people say that homes are an investment, and that is absolutely true for the most part. If you're planning on having children or grandchildren, history has shown that buying a home is the single greatest way to pass down wealth to them. But you have to understand that buying a house comes with the cost of the mortgage, yes, but also a lot of different things that you might not necessarily expect. If you live in an apartment or rent somewhere, then it's on the landlord to repair whatever things might be broken. If you own a house, there's no landlord. So if your water stops running, you've got to pay to get your water turned back on. If it's because of a broken pipe or because of some sort of like septic problem. If your roof starts to fall apart, you've got to pay to fix the roof unless your insurance can shows that it's been caused by something else. But for the most part, costs of home ownership are on the homeowner. So when you're committing to owning a home, you're not just committing to paying the monthly payment, you're also committing to paying for whatever things break that need to be fixed. Okay, and that's all that I have for you guys today. So that's going to go ahead and end this one. Go ahead and submit your notes to me through Canvas so that I know that you took them, and you'll be good to go. Thank you very much.